Many assume superannuation pension are tax-free from age 60, but that's not always true for defined benefit lifetime pensions. In this video, I'll break down the rules with clear examples and share some handy tools to make your calculations and tax returns easier. Let's get started. For people over 60, the tax treatment of a defined benefit lifetime pension comes down to two key factors: the tax component, that is, the breakdown of the tax-free component, taxable taxed element, and taxable untaxed element, and the pension's size, or how it compares to the defined benefit income cap. Let's start with the first factor. You can check the tax components of your lifetime pension easily by looking at your statement or asking your fund. A defined benefit lifetime pension can have one, two, or all three of these tax components, depending on the sources of contributions before it was converted into a benefit. If you're curious about how your pension's tax components are determined, you can usually find the details on your fund's website. Here's an example from PSS. For people over 60, the tax-free component and the taxable taxed element are treated the same for tax purposes, and together they are called the taxed source. The taxable untaxed element is known as the untaxed source. We will come back to that in a moment, but for now, let's look at the second factor. The defined benefit income cap was introduced from 1st of July 2017. It was part of the transfer balance cap reforms, which were designed to limit the total amount of superannuation that can be moved into the tax-free retirement phase pensions. Because defined benefit income streams are generally non-commutable, in other words, they cannot be rolled back into superannuation accumulation account or withdrawn out of the superannuation system, the defined benefit income cap was introduced to apply similar tax treatment to defined benefit lifetime pensions, preventing them from having an unfair tax advantage. The cap is calculated by dividing the general transfer balance cap by 16. Here's a full history of this cap. For the current financial year FY25, it is $118,750. From 1st of July 2025, as the general transfer balance cap increases to $2 million, the defined benefit income cap will be $125,000. Now let's put both factors together. First, we will draw a line representing the defined benefit income cap, which is $118,750 for the financial year 2025. Then we will compare your defined benefit pension to this cap. Think of it like stacking Lego pieces. The taxed source, which includes both the tax-free and taxable taxed components, is always placed at the bottom. On top of that, you stack the untaxed source. If the total pension stays under the cap, the taxed source is not taxed, and the untaxed source is taxed at your marginal tax rate, less a 10% tax offset. Most people have a defined benefit income stream that is under the cap, so it is pretty straightforward. If your defined benefit pension exceeds this cap, things get a little more interesting. In the second scenario, everything below the cap is taxed the same way as in the first scenario. The tax source remains under the cap, so it stays tax-free. The untaxed source up to the cap is still taxed at the marginal tax rate with a 10% tax offset. However, any untaxed source above the cap does not receive the 10% tax offset. It is simply taxed at your marginal tax rate with no reductions. In the third scenario, everything below the cap is still taxed the same way as in the first scenario. The tax source up to the cap remains tax-free. However, 50% of the tax source that exceeds the cap is taxed at your marginal tax rate. Since the tax source has fully used up the cap, the entire untaxed source sits above the cap, meaning it is taxed at your marginal tax rate with no tax offset. If you are more of a flowchart type of person, here's a full breakdown. For the tax source, anything under the cap is tax-free. If it goes over the cap, 50% of the excess is taxed at your marginal tax rate. For the untaxed source, the part under the cap is taxed at your marginal tax rate with a 10% tax offset. The part that exceeds the cap is fully taxed at your marginal tax rate with no offset. Remember the Lego analogy? Always stack the tax source first. Make sure you let the tax source use up the cap first before the untaxed source when you are doing the calculation. Now let's have a look at an example. John is 62 and receives a defined benefit lifetime pension of $180,000 for the entire financial year 2025. The payment is made up of the following components. Step 1. Consider the tax source, which includes both the tax-free component and the taxable taxed element. Since the amount exceeds the defined benefit income cap for the relevant year, 50% of the excess is included in John's assessable income to be taxed at his marginal tax rate, and the remaining remains tax-free. Step 2. Consider the untaxed element. As the defined benefit income cap is already fully utilized by the tax source, the entire untaxed source of $60,000 exceeds the defined benefit income cap. Therefore, all of it is included in assessable income to be taxed at his marginal tax rate, and no tax offset applies. So for John, he will need to include a total of $60,625 in his assessable income, and he does not receive any tax offset. If you want an easier way to calculate all this, you can use this calculator. Just enter the date you start receiving your lifetime pension in the relevant financial year and the tax components of your pension. For John, he received his pension for the entire financial year 2025, so we'll enter the date as 1st of July 2024, the first day he starts receiving it in that financial year. Then we simply enter the tax components and voila, we get the same result. The start date matters for two reasons. First, different financial years have different caps. Second, if your pension starts partway through the year or you turn 60 during the year, the defined benefit income cap needs to be prorated. If John only started receiving this amount on the 24th of November 2024, the defined benefit income cap would need to be prorated. No need to stress though, this calculator does all the work for you. You can download it for free using the link below. Just a quick disclaimer, this video is for educational purposes only, not financial advice. This calculator is built with logic, so you should verify the results with a professional before making any financial decisions. The ATU has its own version. It takes a little longer to use, but it probably covers more uncommon situations. Feel free to try both, I've linked them below. I hope this has been helpful. I'm actively creating a defined benefit series. Please let me know what aspect of defined benefit you would like me to cover. Coming up are pros and cons of a defined benefit super and how to use it alongside the accumulation style of super. Thanks for watching. I'll see you in the next one.